Hey, what's happening, guys? Dan Darrow here with another Options and Play video update. So, hope you all had a fantastic 3-day weekend. Great weekend for football, great weekend for relaxing, resting, catching up on maybe some research, right? That's always what I like to do on these Mondays that are off. Or recently we had the midweek day off for President Bush's funeral. So always great days to kind of get your game plan in order, do some research, just kind of focus on what's coming up on the radar the next few days. So I hope you guys had an enjoyable long weekend. Were able to take advantage of that. So today's video, I actually want to talk about something from last week. Schlumberger. So I'm not I'm not gonna hammer home the idea of oil, or really, like, this video is just not going to touch on oil really at all. And I know it's kind of unusual because Schlumberger reacts to the price of oil, but I really this video is going to be much more just strictly about options. So that's why I wanted in the title to say for option traders, because yeah, obviously the price of oil impacts Schlumberger, but for what I'm looking at, like, I really don't care what oil is doing. So these are basically the three main takeaways that I want to really stress from what I saw on Schlumberger going into earnings and after earnings. So first off, and probably if not the most important, like, the very, very, very high up there, you don't need to be right on the direction to make money trading options around earnings, right? And I can't stress this enough. It's really one of the primary benefits of trading options, is that you don't have to necessarily be right on direction to capitalize, right? And we've seen it time and again, and that's why you see me play strangles so often and straddles. I like to look at stocks for setups that I feel are kind of volatility or underpricing volatility, right? So setups that are kind of direction indifferent. Like, I'm looking at the options, I'm looking at the pricing of the options, and I'm looking at the technical setup. And I want to see, do options appear underpriced or overpriced, or do options appear priced right in line? And we've seen this with a handful of setups over the last month. And I know it's kind of like going over and over the same ideas, but I just can't stress this enough. I mean, with FedEx, with Constellation, with Schlumberger, right? These are setups that there's multiple reasons why the options could have been priced for a bigger than historical move, and in these cases they were all priced below the historical average move, or the recent historical average move, right? So it's not that I necessarily had a direction, and honestly, if I'd had to pick a direction on Schlumberger and the Constellation, I probably would have been wrong on both. I probably would have been bearish on Schlumberger, and I probably would have been bullish on Constellation. But it's the setup. The setup was basically a volatility strategy, right? So it was just saying, like, it had a huge move lower from last quarter. It's way underneath any major area of support. Had a huge bounce off the recent low. Options were pricing in a move underneath its historical average over the last 3 to 4 quarters, and it just seemed like it was set up for a larger than priced in move either direction. So I didn't care which direction it was. I just cared that it moved more than what it was pricing in. So that's what I was saying. Like, I'm direction indifferent. I don't care which, it could go up or go down, but as long as it moved more than the $1.60 that was pricing in, like, that's what I cared about, right? And it was the same thing with Constellation, with STZ, and it was the same thing with FedEx, right? It was I don't necessarily care which way it goes. I just care that it moves more than it's pricing in. So that's one of the key takeaways, right? It's like, you have to look at these trades from a different perspective. It's not just beat and go up or miss and go down. I mean, there's other ways to capitalize, and it's not always being right on direction. Second, and this is something that something that I hammer home a lot too, is you need to have targets, right? When you get into a trade, and you need to have some sort of risk management process that you know look to after each trade, whether it works in your favor or it moves against you, right? Like there needs to be some sort of risk management. So in this case, we were lucky enough to have the trade work in our favor. So let me go for a shorter time frame. Let's go to 30 minutes. So it worked in our favor, right? So you had the move, and typically, because in this case, there when it got through the 50-day, there really wasn't anything significant on the upside. So what I like to do is either use moving averages as target ranges, right? So if it gets up into a key target, key moving average, that could be a target range, or sometimes it's extension level. So if it's a breakout, right? I like a breakout or a breakdown. I like a 10% extension level. That's like kind of like a quick and dirty target range that I use a lot for breakouts or breakdowns out of consolidations. In this case, this was more of a dollar target for the option. So basically, when the stock Schlumberger moved close to double the price did move, then that was the area that I decided that it would made sense to cut risk and roll. Also weighing into that was the fact that the options were shorter dated, right? There was only about a week, a little over a week until expiration. They were this Friday expiration contracts. So there's multiple ways to set targets, but it's important that you have targets. And when it gets to those targets, then it's about trade management. So it's either you can cut risk entirely, take the trade off. Maybe you can if you have multiple contracts, you can take some off the table, or you can roll, right? So that's another one. So that's why in this case you rolled up. So you rolled the contract up to let's go back. So to another weekly call, right? But this one was higher and it was back below the original debit of the trade. So it was cutting risk materially and rolling up to see if it continued, right? Because it had such a strong day and a big move up on good volume that you're saying like, okay, it's a nice 1 day move. Maybe it has another. So you cut risk, you roll up because you're saying like, I want to, potentially keep riding this if it wants to run. But I also realize that the stock is double the price didn't move. The options are short term and I want to take some money off the table, right? So you roll up to a 45 call. And what happens today is that oil gap down, the market gap down, and Halliburton got hit on earnings, so the thing pulled back. So it's like instead of giving back a huge chunk of last week's trade, you'd already cut risk on Friday, so you're giving back less, right? So that's the second thing. You need to have targets, and you need to have well-defined trade management, risk rolling strategies in place, right? Now, the third one, this is a little more nuanced, and this is for specific strategies that are volatility strategies. So when you're playing things both ways, right? And I've talked about this before. There's been some questions about it because it happens it happens more often in fast-moving tapes, right? So if I want to play a stock both ways going into earnings, I want like a bullish position and a bearish position, so calls and puts, right? Oftentimes, I wait until later in the day to get involved in those trades, to put those on, because you run the risk. If you put it on early, then you run the risk of the stock having a significant move during the day, and it completely throws your net debit or your risk profile out of whack, right? So, Schlumberger, not a huge move. I can talk about UTX in a second, but it had a big gap down off the open, right? So if you put the trade on off the open, then what happens was the put side of the trade is going to cost significantly more than the call side because it had gapped down pretty sizably, right? So this was Thursday. Schlumberger reported on Friday, and this was Thursday. So you had a big move lower on Thursday morning. So if you put it on right away, what happens is the stock rallied over $1. So then the put side of the trade cost significantly more than the call side, and then the stock went the opposite way. So the trade got kind of all skewed out of whack. And in this case, it may have worked out regardless, but there's other times when that could really impact the overall profile of the trade. So UTX is another one. So this morning, right? Let me get rid of this. So I was looking at this trade, wanted to play it both ways for earnings, right? But what happened was you had a sharp gap down, and then the stock kept sinking. So if you had put the trade on either right off the open, right? What happened was that basically it sank like another 3 points. So with the stock only pricing in like a 3.5 to 4 point move, and it moves $3 down, then you basically have your position completely skewed to the bear side versus the way the trade was designed. It was more to be even. So it's you want, say, like 50-50 of risk from the bull and bear. Now the trade is like 90 to the bear and only 10 to the bull. And it's, maybe that'll end up working out for you, but that's not really how the trade was designed. So that's why I say if it's like a trade where you're going to play it both ways, so like the bull and bear side, or, a strangle or a straddle or something along those lines, you typically want to wait until later in the day so that you don't run the risk of the stock having a material move and throw in like the trade, risk parameters like all out of whack for you. So those are the three main takeaways, right? And again, as really nothing to do with oil. I know oil impacts it, but there's more important things to take away from Schlumberger earnings and the trade up to earnings that are really relevant to options trading in general and how it can really specifically impact things going forward, because we're just getting into earnings season, and volatility is still, it's off its highs, but today maybe you're seeing the first sign that we're getting back into that two-way tape again, and this becomes super, super important, because if we're going to get those wild intraday swings, you really don't want to have your trades all thrown out of whack before the actual earnings catalyst reads out. All right? So, as always, I'd love to hear from you guys. So, if you want to reach out with questions about upcoming trades or previous trades or even ongoing trades, I'd love to hear from you. So, pass them along either like the comment section here or if you want to reach out email wise. Regardless, I'd love to hear from you. I hope you guys have a great night, and I'll talk to you tomorrow.